All right, we're now getting into study session 9 on financial reporting and analysis. This is the section for the CFA level 1. They call it the financial reporting and analysis, but it's basically accounting. This study session introduces the concepts of financial reporting qualities. This session examines the financial reporting quality differences that may exist between the companies and the means for identifying them. Warning signs of poor or low quality reporting are covered. The applications of financial analysis techniques to evaluate a company's past and projected performance, assesses credit risk, and screens for potential equity investment follows. Common adjustments and reported financials to facilitate cross-company comparisons conclude this session. Reading assessments, we have reading 21 and reading 22. Reading 21 concerns financial reporting quality. Reading 31 concerns financial reporting quality. Reading 32 concerns financial statement analysis and application. Okay, so reading 31, financial reporting quality. Learning outcomes, the candidate should be able to distinguish between financial reporting quality and quantity of reported results. You describe a spectrum of assessing financial reporting quality. Distinguish between conservative and aggressive accounting. Describe motivations that might cause management to issue financial reports that are not high quality. Describe conditions that are conducive to issuing low quality or even fraudulent financial reports. Describe mechanisms that disciplines financial reporting quality and the potential limitations of these mechanisms. Describe presentation choices, including non-GAAP measures that could be used to influence the analyst's options. Describe accounting methods that could be used to manage earnings, cash flows, and balance sheet items. Describe accounting writing warning signs and methods for deducting manipulations of information in financial reports. Introductions. Ideally, analysts would always have access to financial reports that are based on sound financial reporting standards, such as those of the IFRS or the FASB, the Financial Accounting Standard Board, and are free of manipulation. But in practice, the quality of financial reports can vary highly. High-quality financial reporting provides information that is useful to analysts to assessing a company's performance and prospects. Low-quality financial reporting contains inaccurate, misleading, or incomplete information. Extreme lapses in financial reporting quality have given rise to high-profile scandals that result not only in the investors' losses, but also in the reduced confidence in the financial system. Financial system statements users were able to accurately assess financial reporting quality, were better positioned to avoid losses. These lapses illustrate the challenges analysts face, as well as the potential cost of failing recognizes practice but results in misleading or inaccurate financial reports. Examples of misreporting can provide an analyst with insight into various signals that may indicate poor quality financial reports. It is important to be aware, however, that high-profile financial scandals reflect only those instances of misinterpretation that were identified. Although no one can know the extent of undetected misreporting, some research suggests that relatively widespread. A survey of 3,000 board members, executives, managers, and other employees of 36 countries across Europe, the Middle East, or West Asia, as I like to call it, because I live in East Asia, India and Africa, indicates that 20% of respondents have seen manipulation occurring in their own companies, and 42 of board directors and senior managers were aware of some type of irregular financial reporting in their own companies. Another survey of 169 chief financial officers in public U.S. companies found that they believe, on average, that 20% of companies internationally distort earnings and to misrepresent economic performance, even while adhering to U.S. GAAP. And for such companies, the magnitude of misrepresentation is about 10% of reported earnings. This reading addresses financial reporting quality, which pertains to the quality of information in financial reports, including disclosures and notes. High-quality reporting provides decisions useful information, which is relevant to faithfully represent the economic reality of the company's activities during the reporting period, as well as the company's financial condition. At the end of the period, a separate but interrelated attribute of quality is quality of reported results or earning quality, which pertains to earnings, the cash generated by companies' actual economic activities and the resulting financial conditions. The term earning quality is commonly used in practice and will be used broadly to encompass the quality of earnings, cash flows, and or balance sheet items. High quality earnings result from activities that companies will likely be able to sustain in the future and provide a sufficient return on the company's investments. The concepts of earning quality and financial reporting quality are interrelated because correct assessments of earning quality is possible only when there is some basic level of financial reporting quality. Beyond the basic level, as quality of reporting increases, the ability of financial statements users to correctly assess earnings quality and to develop expectations for future performance arguably also increases. Let me drink my drink. Today I'm drinking orange juice with pomegranate in it. I went to Costco and bought this drink. It's actually quite good. A little too sweet though. Probably if I put some booze into it, it'll be better. I don't know. Section 2 provides a conceptual overview of reporting quality. Section 3 discusses motivations that might cause the condition that might enable management to issue financial reports that are not high quality of mechanisms that aims to provide discipline to financial reporting quality. Section 4 describes choices made by management that can affect financial reporting quality. Presentation choices, accounting methods, and estimates, as well as warning signs of poor quality financial reporting. Conceptual overview. As indicated in the introduction, financial reporting quality and results of earnings quality are interrelated attributes of quality. Exhibit 1 illustrates the interrelationship and its implications. As can be seen in Exhibit 1, if financial reporting quality is low, the information provided is not useful to assess a company's performance and thus make investments and other decisions. Financial reporting quality varies across companies. High quality reports contains information that are relevant, complete, neutral, and free of error. The lowest quality report contains information that is pure fabrication. Earnings results quality can range from a high and sustainable to low and unsustainable. Providers of resource prefers high and sustainable earnings. Combines these two measures of quality, financial reporting of earnings, the overall quality of financial reports from a user's perspective can be thought of as spanning the continuum of the highest to lowest. Exhibit 2 presents a quality spectrum that provides the basis for evaluating better versus poor reporting quality. Okay, so here's the reporting quality. GAAP decision useful, sustainable, and adequate returns. On the top of the spectrum, label Exhibit 2 as GAAP decision useful, sustainable, and adequate returns. High quality reports that provides useful information about the high quality earnings. High quality financial reports confirms to the generally accepted accounting principles, the GAAP, of its jurisdiction, international financial reporting standards. U.S. GAAP or other home country. U.S. GAAP, the exhibit uses the term GAAP to refer generically to accounting standards accepted in the country's jurisdiction. In addition to conforming to GAAP, high-quality financial reports also embody the characteristics of decision-useful information, such as those defined in the conceptual framework. Recall the fundamental characteristics of useful information are relevance and faithful representation. Relevant information is defined as information that can affect a decision of encompasses a notion of materially. Faithful representation of economic events is complete, neutral, and free from error. The conceptual framework also enumerates enhancing characteristics of useful information, comparability, verifiability, timeliness, and understandability. Of course, the desirable characteristics for financial information requires trade-offs. For example, financial reporting must balance the aims of providing information that are provided quickly enough to be timely and thus relevant, and yet not so quickly that errors occur. Financial reports must balance the aim of providing information that is complete but not exhaustive and immaterial information is included. High quality information results when these and other trade-offs are made in an unbiased, skillful manner. High quality earnings indicates an adequate level of return on investment and derive from activities that a company will likely be able to sustain in the future. An adequate level of return on investment exceeds the cost of the investment and also equals to exceeds the expected return. Sustainable activities and sustainable earnings are those expected to recur in the future. Sustainable earnings that provide a high return on investment contribute to higher valuations of a company and its securities. USGAAP decision useful but sustainable. The next level down in Exhibit 2, GAAP decision useful but sustainable refers to circumstances in which high quality reporting provides information, but the information reflects results or earnings that are not sustainable. The earnings may not be sustainable because the company cannot expect earnings that generate the same level of returns on investment in the future, or because the earnings, although replicable, will not generate sufficient returns on investment to sustain the company. Earnings quality is low. In both cases, reporting can be could be high quality even when the economic reality being depicted is not of high quality. For example, consider a company that generates a loss, or earnings that do not provide an adequate return on investment, or earnings that resulted from non-recurring activities. The relative undesirable economic reality can nonetheless be depicted in financial reporting that provides high quality or decision useful information. Bias accounting choices, the next level down of the spectrum, Exhibit 2 with GAAP, but bias choices. Bias choices result in financial report that do not faithfully represent economic phenomenon. The problem with bias in financial reporting, as with other deficiencies in financial reporting quality, is that impedes the investor's ability to correctly assess a company's past performance, to accurately forecast future performance, and thus to appropriately value the company. Choices are deemed to be aggressive if they increase companies' reported performance and financial positions in the current period. The choice can increase the amount of revenues, earnings, and or operating cash flows reported in the period, or decrease the amount of expenses reported in the period and or amount of debt reported on the balance sheet. Aggressive choices may decrease the company's reported performance and financial positions in later periods. In contrast, choices are deemed conservative if they decrease a company's reported performance and financial positions in the current period. Conservative choices may decrease the amount of revenues, earnings, and or operating cash flow reported in the period, or increase the amount of expenses reported in the period and or the amount of debt reported in the balance sheet. Conservative choices may increase the company's reported performance and financial positions in later periods. Another type of bias is understatement of earnings volatility, so-called earnings smoothing. Earnings smoothing can result from conservative choices to understate earnings in periods when a company operates and performing well, plus aggressive choices in periods when a company's operations are struggling. Biased choice can be made not only on the context of reported amounts, but also in the context of how information is presented. For example, companies can disclose information transparently in a manner that facilitates analysis, or they could disclose information in a manner that aims to obscure unfavorable information and or emphasize favorable information. While choices exist with GAAP with presentation of a desired economic picture, non-GAAP reporting adds yet another dimension for management direction. Non-GAAP reporting includes both non-GAAP financial metrics and non-GAAP operating metrics. Non-GAAP financial metrics relates directly to the financial statement. A common non-GAAP financial metric is a non-GAAP earning, which are earnings matrix created by reporting companies that adjust standards, compliant earnings to exclude items required by accounting standards, or to include items not permitted by accounting standards. In contrast, non-GAAP operating metrics do not relate directly to the financial statements and include metrics that are typically industry-driven, such as subsidiaries, active users, and occupancy rates. Non-GAAP financial reporting can become increasingly common. This development presents challenges to analysis. An important challenge is the non-GAAP financial reporting that diminishes comparability across financial statements. The adjustments that companies make to create non-GAAP earnings, for example, are generally ad hoc and thus differ significantly across companies. When evaluating non-GAAP financial metrics, investors must decide the extent to which specific adjustments should be incorporated into their analysis. In general, for all non-GAAP metrics, investors need to decide how such metrics should be incorporated in their analysis and forecast. Management emphasis on non-GAAP financial measures, such as pro forma earnings, to deflect attention from less than desirable financial results, is an example of an aggressive presentation choice. Since 2003, if a company uses non-GAAP financial measure in an SEC filing, it is required to display the most directly comparable GAAP measure with equal prominence and to provide reconciliation between the non-GAAP measures and equivalent GAAP measures. In other words, a company is not allowed to give more prominence to a non-GAAP financial measure in an SEC filing. Similarly, the IFRS Practice Statements Management Commentary issues December of 2010 requiring disclosures from non-IFRS measures are included in the financial reports. The reconciliation between as per reported measures and as just measures can provide important information. Often, poor reporting quality occurs simultaneously when poor earnings quality, with poor earnings quality, for example, aggressive accounting choices are made to obscure poor performance. It is possible, of course, for poor reporting quality to occur with high quality earnings. Although a company with good performance would not require aggressive accounting choices to obscure poor performance, it might nonetheless produce poor quality reports for other reasons. A company with good performance might be unable to produce high quality reports because of inadequate internal systems. Another scenario is in which poor reporting quality might occur simultaneously with high quality earnings is that a company with good performance might deliberately produce reports based on conservative rather than aggressive accounting choices. That is, choices that make current performance look worse. On motivations might be to avoid unwanted political intentions. Another motivation can arise from periods in which management has already exceeds targets before the end of the period and thus makes converse accounting choices would delay reporting profits until the following period, so-called hidden reserves. Similar motivations might also contribute to accounting choices that creates appearance that the trajectory of the future results will appear more attractive. For example, a company might make a choice to accelerate losses in the first year of the acquisition or the first year of a new CEO's tenure so that the trajectory of the future results will appear more attractive. Overall, unbiased financial reporting is the ideal, and the performance and the preference. Investors may prefer conservative choices rather than aggressive ones. However, because a positive surprise is easier to tolerate than a negative surprise, bias reporting, whether conservative or aggressive, adversely affects the user's ability to assess a company. The quality spectrum considers the more intuitive situations in which less than desirable underlying economics and a central motivation for poor reporting quality. In addition, it is necessary to have some degree of reporting quality in order to evaluate earning qualities. Proceeding down the spectrum, therefore, the concept of reporting quality and earnings quality becomes progressively less distinguishable. Within GAAP and earnings measurement or management, the next level down in the spectrum in Exhibit 2 is labeled within GAAP, but earnings management. The term earnings management is defined here as making intentional choices and create biased financial reports. The distinction between earnings management and biased choices are subtle and primarily a matter of intent. Earnings measurement represents the deliberate action to influence reported earnings and their interpretations. Earnings can be managed upwards or increase by taking real action, such as deferring research and development expense into the next reporting period. Alternatively, earnings can be increased by accounting choices such as changing accounting estimates. For example, the amount of estimated product returns, bad debt expense, or asset impairment could be decreased. Because it is difficult to determine intent when we include earnings measurement under the bias choice discussion. Departure from GAAP, the next level down in the spectrum, Exhibit 2 marks departures from GAAP. Financial reporting that departs from GAAP can generally be considered low quality. In such situations, earnings quality is likely difficult or impossible to assess because comparisons with earlier periods and or other entities cannot be made. An example of improper accounting with Enron was inappropriate because of office balance sheet structures and other complex transactions result in a vastly understated indebtedness as well as overstated profit and operating cash flows. Another notorious example of improper accounting will be WorldCom. Accounting issues discovered in 2002, a company that by improperly capitalizing certain expenditures dramatically understated its expenses and thus overstating its profit. More recently, New Century Financial accounting issue revealed in 2007 issued billions of dollars in subprime mortgage and it improperly reserved only minimal amounts of loans repurchases. Losses. Each of these companies subsequently filed for bankruptcy in 1980. Polypec International (PPI) reported current losses included in the normal course of its operations. Directly due entity equity rather than its profit and loss statement in 1990. Sunbeam and properly reported revenues and bill and hold sales and also manipulated the timing and expenses and the effects of falsely portraying understanding performance and a new chief executive. At the bottom of the quality spectrum, fabricated reports portray fictitious events, either to fraudulently obtain investment or misrepresent a company's performance and or obscure fraudulent misrepresentation of the company's asset. For example, examples of fraudulent reporting and unfortunately easy to find. Although they were not necessarily easy to identify at the time, 1970s Equity Funding Corp created fictitious revenues and even fictitious policyholders. In 1980s, the Crazy Eddies reported fictitious inventory as well as fictitious revenue supported by fake invoices. In 2004, Paramalat reported fictitious bank balances. Let me drink my juice. Differences between conservative and aggressive accounting. This section returns to the implications of conservative and aggressive accounting choices. As mentioned earlier, unbiased financial reporting is an ideal, but investors may prefer to be perceived to prefer conservative rather than aggressive accounting choices because a positive surprise is acceptable. In contrast, management may prefer or be perceived to prefer aggressive accounting choices because they increase the company's reported performance and financial position in the current period. Aggressive accounting choices in the current period may decrease the company's reported performance and financial positions in later periods, which creates a sustainability issue. Conservative choices do not typically create a substantial sustainability issue because they decrease the company's reported performance and financial position in current periods and may increase the reported performance and financial position in later periods. In terms of establishing expectations of the future, however, financial reporting that is relevant and faithfully representative is the most useful. A common presumption in the financial reports are typically biased upwards, but that is not always the case. Although accounting standards ideally promotes unbiased financial reporting, some accounting standards may specifically require a conservative treatment of the transactions or an event. Also, managers may choose to take conservative approaches when applying standards. It is important that the analyst considers the possibilities of conservative choices and their effects. at its most extreme, conservatism follows accounting practices as anticipate no profit, but anticipate all losses. But in general, conservatism means that revenues may be recognized once a verifiable and legally enforceable receivable has been generated, and the loss needed to be recognized until it becomes probable. The unavoidable conclusion in this conservatism, which can now be characterized as a delay in the recognition and profit from when they are actually created until the point at which they are subject to significantly high levels of verification, sometimes impairs the relevance of financial statements for external decision makers. In the particular case of oil and gas explorations and production, many jurisdictions require extensive supplemental disclosures about operations, which reduces the problem to a degree. Standards across jurisdictions may differ on the extent of conservatism embedded within the standard, and analysts should be aware of the implications of accounting standards on financial reports. An example of the different treatments by IFRS and US GAAP for the impairment of long-lived assets. Both IFRS and US GAAP specify an impairment analyst protocol that begins with an assessment of whether recent events indicate that the economic benefit from the individual or group of long-lived assets may be less than its carrying amount. From this point of view, however, the two regimes diverge. Under IFRS, the recoverable amount is less than the carrying amount, and the impairment which will be recorded. Under USGAAP, an impairment charge will be recorded only when the sum of the undiscounted future cash flow expected to be derived from the asset is less than the carrying amount. If the undiscounted cash flow are less than the carrying amount, then the asset is written down to fair value. To illustrate the difference in application, assume that a factory is the unit of account eligible for impairment testing. If carrying amount is 10 million, fair value and receivable amount and both 6 million, the undiscounted future net cash will be associated with a factory total of, under IFRS, it will be 4 million. Under USGAAP, no impairment changes will be recognized. Thus, on its face, IFRS will be regarded as more conservative than USGAAP because impairment losses will normally be recognized earlier under IFRS than under USGAAP, but taking the analysis one step further, such a broad generalization might not hold up. For example, if an asset is impaired under both IFRS and USGAAP, and the asset's value is exceeds its fair value, the impairment loss under USGAAP will be greater. Also, IFRS permits the recognition of recoveries of the receivable amount of subsequent periods if evidence indicates that the recoverable amount has subsequently increased. In contrast, USGAAP prohibits the subsequent write-up of an asset after an impairment charge has been taken. It would recognize the asset's increased value only when the asset is ultimately sold. Other common examples of conservatism in accounting standards includes the following: research costs, litigation costs, insurance costs, commodity inventory. Okay. Biased in the application of accounting standards. Let me drink my juice. Any application of accounting standard, whether a standard itself is neutral or not, often requires significant amount of judgment. Characterizing the application of an accounting standard on conservative or aggressive is a more matter of intent rather than definition. Careful analysis of disclosures, facts, and circumstances contribute to making an accurate inference of intent. Management seeking to manipulate earnings may take a longer view by sacrificing short-term profitability in order to ensure higher profits in longer periods. One example of biased accounting is the guise of conservatism in the so-called Big Bath restructuring charges. Both IFRS and USGAP provides for accrual of future costs associated with restructuring. And these costs are often associated with the presented along with asset impairments, but in some instances, Companies use the accounting provisions to estimate big losses in the current period so that performances in future periods will appear better. Having observed numerous instances performance in future periods manipulation practice in the late 1990s, the U.S. companies set up opportunities to report higher profits in future periods that were not connected with performances in those periods. The SEC staff issues rules that narrows the circumstances under which costs can be categorized as part of a non-recurring restructuring event, and enhances the transparency surrounding restructuring charges and asset impairment. A similar manifestation of big bath accounting is often referred to as cookie jar reserve accounting. Both US GAAP and IFRS requires accrual of estimates of future non-payments of loans. In his 1999 speech, The Number Game, SEC Chair Arthur Levitt expressed his general concern that the corporations were overstating loans and other forms of losses allowance for the purposes of smoothing income over time. In 2003, the SEC issues an interpretive guidance for essentially requires a company to provide a separate section in management decisions to an analysis titled Critical Accounting Estimates. If the effects of subjective estimates and judgments are highly uncertain matters and are material to stakeholders, disclosures of their nature and exposures to uncertainty should be made in the MD&A. This requirement is in addition to the required disclosures in the notes and the financial statements. Context for assessing financial reporting quality. In assessing financial reporting quality, it is useful to consider whether a company's managers may be motivated to issue financial reports that are not high quality. If motivations exist, an analyst should consider whether the reporting environment is conducive to managers' misreporting. It is important to consider mechanisms within the reporting environment that disciplines financial reporting quality, such as the regulatory regime. Motivations. Managers may be motivated to issue financial reports that are not high quality to make poor performance, such as loss or market share or lower profitability than competitors. Lewis stated, firms experiencing performance problems, particularly those it considers transient, may induce a response that inflates current earnings numbers in exchange for future earnings. Even when there are no need to mask poor performance, managers frequently have incentives to meet or beat market expectations to reflect the analyst's forecast and or management's own forecast. Exceeding forecast typically increases stock price, if only temporarily. Additionally, exceeding forecast can increase management's compensation that is linked to the increase in stock price of reported earnings. Graham Harvey and Raj Gopal found that the CFOs they surveyed view earnings as the most important financial metric to financial markets. I mean, that's actually not that surprising. Achieving or exceeding particular benchmarks, including prior year's earnings and analyst forecasts, is very important. The offer examines a variety of motivations for why managers might exercise accounting discretion to achieve some desirable earning goals. Motivations to meet earnings benchmarks include equity market effects and trade effects. Equity market effects are the most powerful incentives, but trade effects are also important, particularly for small companies. Career concerns and incentive compensation may motivate accounting choices. For example, managers might be concerned that working for a company that performs poorly will limit their future career opportunities, or that they will not receive a bonus based on exceeding the particular earnings target. In both cases, management might be motivated to make accounting choices to increase earnings. In a period of marginally poor performance, a manager might accelerate or inflate revenues and or delay or underreport expenses. Conversely, in a period of strong performance, a manager might delay the revenue recognition or accelerate expense recognition and to increase the profitability or exceeding the next period's targets. The surveyed managers indicate a greater concern with career implications of results than the incentive compensation implications. Avoiding Avoiding debt covenants violations can motivate managers to inflate earnings. Graham Harvey and Rajgo Powell's survey indicates that avoidance of bond covenants violations is important to highly leveraged and unprofitable companies, but relatively unimportant overall. Conditions conducive to issuing low-quality financial reports, as discussed. Deviations from a neutral presentation of financial results can be driven by management's choices or a jurisdiction's financial reporting standards. Ultimately, a decision to issue low quality or even fraudulent financial reports is made by an individual or individuals. Why individuals make such choices is not always immediately apparent. For example, why would the newly appointed CFO of Sunbeam, who already had a net worth of more than 100 million, commit accounting fraud by improperly reporting revenues from Bell and Hold sales and manipulating the timing and expenses? Rather than admit to lower than expected financial results? Typically, three conditions exist with low-quality financial reports and issues: opportunity, motivations, and rationalization. Opportunity can be the result of internal conditions, such as poor internal controls and or an ineffective board of directors, or external conditions, such as accounting standards that provide scope for divergent choices or minimal consequences for an inappropriate choice. Motivations can result from pressures to meet some criteria for personal reasons, such as a bonus, or a corporate reason, such as concern about financing in the future. Rationalization is important because if an individual is concerned about a choice, he or she needs to be able to justify it to him or herself. Former Enron CFO Andrew Fausto speaks at a 2013 Association Certified Fraud Examiner annual fraud conference. Indicate that he knew at this time that he was doing something wrong by following the procedures to justify his decision. He made sure to get management on board approval, as well as legal and accounting opinions, and so include appropriate disclosures. The incentives and corporate cultures were to create earnings rather than to focus on long-term value. Clearly, as reflected in his prison sentence, he did something that was not only wrong but illegal. Mechanisms that discipline financial reporting quality. Markets potentially discipline financial reporting quality. Companies and nations compete for capital, and the cost of capital and the function of perceived risk, including the risk of a company's financial statement with skewed investors' expectations. Thus, in the absence of other conflicting economic incentives, a company seeking to minimize its long-term cost of capital should aim to provide high-quality financial reports. In addition, to markets, other mechanisms also discipline financial reporting qualities, include market regulatory authorities, audits, and private contracts. Market regulatory authorities, companies seeking to minimize the cost of capital should maximize reporting quality. But as discussed earlier, conflicting incentives often exist. For this reason, national regulations and the regulators that establish and enforce these rules can play a significant role in financing reporting quality. Many of the world's security regulations are members of the International Organization of Security Commissions, the IOSCO. IOSCO is recognized as the global standard for setting a setter for security sector, although it does not actually set standards, but rather establishes objectives and principles to guide securities and capital market regulations. IOSCO's members include more than 120 security regulators and over 80 other security market participants, such as stock exchanges. One member of the IOSCO is the European Security and Market Authority, the ESMA, an independent EU authority with a mission to enhance the protection of investors and reinforce stable and well-functioning financial markets in the European Union. ESMA organizes financial reporting enforcement activities through a forum consisting of financial and European enforcers from European Economic Area countries. Direct supervision and enforcement activities are performed at the national level. For example, the Financial Conduct Authority, the FCA, is the IOSCO member with the primary responsibility for securities regulations in the United Kingdom. ESMA reported that European enforcers perform 850 full and 1,100 partial reviews of company accounts in 2011, which in turn led to enforcement activities with the following outcomes. 18 amended reports to restate financial statements, and approximately 150 public corrective notes and assessed notes and announcements, and approximately 420 required corrections in future financial statements. Another member of IOSCO is the U.S. Regulatory Authority and the Securities of Exchange. The SEC is responsible for overseeing approximately 9,100 U.S. public companies and reviews the disclosures of the companies at least once every 3 years, with the aim of improving information available to investors and potentially uncover possible violations of securities laws. In 2002, the SEC reported it has filed 515 enforcement actions for financial reporting and disclosure violations during the preceding 5 years, a period in which 68% of the named parties were charged with fraud. Examples of regulatory bodies in Asia includes the Financial Service Agency in Japan, the China Securities Regulation Commission, the Securities of Exchange Board of India. Examples of regulatory body in South America includes Comisión Nacional de Valores in Argentina, the Comisión de Valores Mobilización in Brazil, and the Superintendencia de Valores y Seguros in Chile. A full list of ISO members can be found in the organization's website list. Typical features of regulatory regimes that most directly affect the financial reporting quality includes the following: registration requirements, disclosure requirements, auditing requirements, management commentaries, or responsibility statements, regulatory review of filings, enforcement mechanisms, auditors. Okay, let's read this. As noted, regulatory authorities typically require that public traded companies' financial statements be audited by an independent auditor. Private companies also obtain audit options for their financial statements, either voluntary or because audit reports are required by outside parties, such as providers of debt or private equity. Audit opinion provides a financial statement users with some assurance that the information compiles with the relevant set of accounting standards and present the company's information fairly. Exhibit 7, 8, and 9 provides excerpts from the independent auditors from this company, and this company, respectfully. Notes that each of these companies, the auditors issued the unqualified or the clean opinion that reflects the specific requirements of the company's regulatory regime. For example, the audit opinions of the Novartis includes the SEC required opinion on the effectiveness of internal controls because the Novartis securities trades in the United States. The SEC permits non-U.S. companies to report using U.S. GAAP, IFRS, as issued by the IASB, or home country GAAP, general accounting practices. If a company reports general accepted accounting practices. Okay, so here are the examples. Although audit opinions provide disciplines for financial reporting quality, inherent limitations exist. First, an audit opinion is based on review of information prepared by the company. If a company deliberately intends to deceive its auditor, a review of information might not be uncovered misstatements. Second, an audit is based on sampling, and the sample might not reveal misstatements. Third, an exemption gap may exist between the auditor's role and the public's exemption of auditors. An audit is not typically intended to detect fraud if it is intended to provide assurance that the financial report are fairly presented. Finally, the company being audited pays the audit fees, often established through a competitive process. This situation can provide an auditor with an incentive to show leniency and to the company being audited, particularly if the audited firm provides additional services to the company. Okay, so here's the example. Detecting of financial reporting quality issues. Choices in applications of accounting standards abound, which is perhaps one reason why accounting literature and texts are so voluminous, compounding the complexity. Measurement often depends on estimates of economic phenomenon. Two estimates might be justifiable, but they may be significantly different effects on the company's financial statements. As disclosed earlier, the choice of a particular estimate may depend on the motivations of the reporting company's managers, which may be choices available and inherent flexibility of estimates in the accounting process. Managers have many tools for managing the meeting analysis expectations through financial reporting. Let me get some more water really fast. I'll be back in like 30 seconds. I watered down my juice because it got too sweet. Okay. An understanding of the choices and that companies make in financial reports is fundamental to evaluating the overall quality, both financial reporting and earnings quality of the reports preceded. Choices exist between how information is presented and how financial results are calculated. Choices is presented may be fairly transparent to investors. Choices in the calculations of financial results, however, may be difficult to discern because they can be deeply embedded in the construction of reported financial results. The availability of accounting choices enables managers to affect the reporting of financial results. Some choices increase performance and financial positions in a current period, and others increase them in later periods. A manager that wants to increase performance and financial positions in the current period could recognize revenue prematurely, use non-recurring transactions to increase profit, defer expenses to later periods, measure and report assets at higher values, or measure the report liabilities at lower values. A manager that wants to increase performance and financial positions in a later period could defer current income and to later periods and or recognize future expenses in the current period, setting the table for improving future performance. The following section describes some of the potential choices that for how information is presented and how accounting elements are recognized, measured, and reported. In addition to choices within GAAP, companies may prepare fraudulent reports. For example, their report may include non-existent revenues or assets. Section 4 concludes with some of the warning signs that indicate companies' poor financial reports. Presentation choices. Technology booms in the 1990s and the internet bubble in the early 2000s featured companies popular with investors that often shared the same characteristic. They could not generate enough current earnings to justify their stock prices. Using the traditional price-to-earnings ratio approaches to valuations, many investors choose to explain their apparent anomalies by rationalizing the old focus on profits, and traditional valuation approaches no longer apply to such companies. Strange new metrics for determining operating performance emerged. Website operators spoke of eyeballs that could be captured in a quarter. Are the sickliness of the websites and the website surfers. Many technology companies were accomplished practitioners of pro forma reporting, where they were not the first to use. In the early 1990s, downsizing of large companies were a commonplace event. The massive restructuring charges obscured the operating performance at many established companies. For example, as it learned to cope with the world that embraced the potential computer rather than manufacture the mainframe computing. International Business Machines, or IBM, reported massive restructuring changes in 1991 to 1993, respectively. Since shares incurred $2.7 billion of infrastructure change in 1993, and AT&T reported restructuring charges of $7.7 billion in 1995. These events were not isolated. The restructuring charges were a standard quarterly reported event. To counter perceptions that their operations were floundering, and supposedly to assist investors in evaluating operating performance. Companies often sanitize earnings releases by excluding restructuring charges and poor format measures of financial performance. Accounting principles for reporting business combinations also played a role in boosting the popularity of pro forma earnings. Before 2001, acquisitions of one company may another often result in goodwill amortization charges that made subsequent earnings report look weak. Complications matters that were two accounting methods for recording acquisitions: pooling of interest and purchasing methods. The new extinct pooling of interest treatments were difficult for companies to achieve because of the many restrictions of criteria for its use, but it was greatly desired because it did not result in goodwill amortization charges in the technology boom period. Acquisition were common, and many were reported as purchases, with consequential goodwill amortization dragged down earnings with long as 40 years under then existing rules. Acquisitive companies reporting under purchase accounting standards perceive themselves to be reporting the disadvantage compared to with companies able to apply pooling or of interest accounting. The companies reporting under purchase accounting began to present earnings adjusted for the exclusion of amortization of intangible assets and goodwill, because investors tried to make intercompany comparisons on a consistent basis. Earnings before interest, taxes, depreciation, and amortization becomes an extremely popular performance measures. EBITDA is widely viewed as eliminated noisy reporting signals. The noise may be introduced by different accounting methods among companies for depreciation, amortization of intangible assets, and restructuring charges. Companies may construct the report of their own versions of EBITDA, for sometimes referring to as adjusted EBITDA, by adding the list of items excluded from the net income. Items that analysts might encounter include the following. Among other incentives for spread of non-GAAP earnings measured for loan covenants, lenders may make demands for a borrowing company that requires archiving and maintaining performance criteria, defining by using GAAP net income as a starting point, but arriving at a measure suitable to its lender. A company may use this measure as its preferred US GAAP or non-GAAP metric in earnings releases, and it also may use the measure in describing its liquidity or solvency situation in management commentary. As mentioned earlier, if a company uses non-GAAP financial measures in an SEC filing, it must display the most directly comparable GAAP measure with equal performance, and provide reconciliation of the non-GAAP measure and the equivalent GAAP measure. Measurement must explain why it is believed that non-current non-GAAP financial measures provides useful information regarding the company's financial conditions and operations. Measurement must also disclose additional purposes if material for which it uses the non-GAAP financial measures. Similarly, IFRS requires a definition and explanation of non-IFRS measures included in financial reports, including why the measures is potentially relevant to users of the financial reports. Management must provide reconciliation of non-IFRS measures with IFRS measures presented in the financial reports. These seem to be a general concern that management may use non-GAAP measures to distract a user's attention from GAAP measures. The SEC intended that the definition of non-GAAP financial measures capture all measures that have the effect of depicting either a measure of performance that differs from the presented in the financial statement, such as income or loss before taxes, or net income or loss as calculated in accordance with GAAP, or a measure of liquidity that differs from cash flow or cash flows from operating computed in accordance with GAAP. The SEC prohibits the exclusion of charges or liabilities requiring cash settlement from any non-GAAP liquidity measures other than EBIT or EBITDA. Also prohibited is the calculation of non-GAAP performance measures intended to eliminate or smooth items tagged as non-reoccurring, infrequent, or unusual, with such items as very likely to occur again. SEC views the period within 2 years of either before or after reporting dates as relevant timeframes for considering whether a charge or a gain is a recurring item. Example 6 describes the case of misuse or representing of non-GAAP measures. Accounting choices and estimates. Choices do not necessarily involve complex accounting standards. Something simple as shipping terms for good delivered to customers can have a profound effect on the timing of revenue. On the last day of the first quarter, suppose a company ships $10,000 of goods to a customer on the terms of free to board of FOB shipping point. Arriving the next day, the shipment term means that the customer takes title of the good and bears the risk of loss. At the time of goods leave to sellers loading the dock, bearers bearing any issue with collectability of the receivables or likelihood of a return, the seller will be able to recognize revenue on the sale along with the associated profit. That revenue and profit will be recognized in the first quarter of the year. Change the point at which the goods title is transferred to the customers, the FOB destination. The revenue patterns will be completely different. Under these terms, the title and risk of loss transferred to the customers when the goods arrive at the destination. The shipment arrives the following day, which is the starting of the new accounting period. A simple change in shipping terms can make the difference between revenue and profits in the current period, or postponing them until the next period. Shipping terms can also influence management behavior. To make the numbers, managers may push product out of the door prematurely under FOB shipping point arrangements in order to reflect as much revenue as possible in the current period. Alternatively, in the case of overburdens of orders, the company could run the risk of exceeding the analyst's concession by estimates by a long margin. Management might be uncomfortable periods in which expectations were exceeded. Management might want to prevent investors from becoming too optimistic. If possible, delay revenue recognition until a later quarter. This result can be accomplished by fulfilling customer orders by initially delivering on the last day of the quarter, with shipping terms such as the FOB, possibly in the scenario of the customers intended as on FOB shipment point terms, as selling companies could simply delay shipments until after the close of the quarter. This illustration also highlights a difficult distinction for investors to make. A company may use accounting as a tool to aggressively promote earnings growth, as in the example with the premature shipment of goods with FOB shipping point terms, but it may be aggressively managing the business flow by slacking off on shipping goods when business is too good. As in the second example, in either case, a desired management outcome is obtained by a simple change in shipping terms. Yet, many investors may be inclined to say that the second example is a conservative kind of earning measurement and accept it, even though it artificially masks the actual economic activity that occurred at the time. How accounting choices and estimates affect earnings and balance sheet assumptions about inventory cost flows provides another examples of how accounting choices can affect financial reporting. Companies may assume that their purchase of inventory items are sold to customers on first in, first out, FIFO basis, with the result that the remaining inventory reflects the most recent cost. Alternatively, they may assume that the purchase of inventory items are sold to customers on a weighted average cost basis. Example 7 makes the point of merely choosing a cost flow assumption can affect profitability. In the previous example, simplified and extreme for the purposes of illustrating clearly, but the point is important. Management's choices among acceptable inventory assumptions and methods affecting profits. The selection of an inventory costing method is a policy decision, and companies cannot arbitrarily switch from one method to another at random. The selection does not matter to profitability, however, and it is also matters to a balance sheet. In periods of changing prices, the FIFO cost assumption will provide a more current picture of ending inventory values because the most recent purchase will remain in inventory. The balance sheet will be more relevant to investors. Under the weighted average cost assumption, however, the balance sheet will display a blend of old and new costs during inflationary periods. The value of inventory will be understated. The company will not be able to replenish its inventory at the value shown. At the same time, the weighted average inventory cost method ensures that the more current costs are shown in the cost of sales, making the income statement more relevant. Then the FIFO assumption trade-off exists, and investors should be aware of how accounting choices affect financial reports. High-qualified financial reporting periods users sufficient information to assess the effects of accounting choices. Estimates abound in financial reporting because of its use of accrual accounting, which attempts to show the effects of all economic events on a company during a particular period. Accrual accounting stands in contrast to the cash basis accounting, which shows only the cash transactions conducted by a company. Although a high degree of certainty exists with reporting only cash transactions, much information is hidden. For instance, a company with growing revenues that makes the majority of its cash transactions in an accrual basis. Revenues reflect all transactions that occurred. Proceeds because some facts related to events occurring in a particular period might not yet be known. Estimates can be well grounded in reality and are applied to present a complete picture of its events affecting a company, or they can be management tools for achieving a desired financial picture. To illustrate how estimates affect financial reporting, consider revenues that include credit sales. When company sells $1 million of merchandise on credit and records the sale just before year's end. Under accrual accounting, this amount is included in revenues and accounts receivable. The company's managers are known from experience that they will never collect every dollar of the accounts receivables. Past experience is that on average only 97% of the accounts receivable is collected. Let me drink my juice real fast. Yet accrual accounting poses temptations to managers to manage numbers rather than to manage the business. Damn, that's a well-written line. Accrual accounting poses temptations to managers to manage the numbers rather than to manage the business. That's a well-stated line. I like this quote. Suppose the company's managers realize that the company will not meet the analysis consensus estimate by a particular quarter, and further payment terms or discounts. The managers may induce customers to take delivery of products that they would normally not order, so they could ship the products on FOB shipping at point terms and recognize the revenues in the current quarter. They could even be so bold as to ship the goods under these terms, even if the customer did not order them, in hopes of the customers will keep them or at worst return them in the next accounting period. Their focus would be to move their product off the company's property with FOB shipping point terms. To further improve earnings in order to meet the consensus estimates, the company's managers might revise their estimates of the collectible account. The company's collectible history shows a typical non-collection rate of 3% sales, but the managers might rationalize to use a 2% non-collection rate. This change will reduce the allowance for non-collectible accounts for an uncollectible accounts expense reported for the period. The managers might be able to justify the reduction on the grounds of economic outlook, or that that a company's collection history has been biased by the inclusion of prolonged periods of economic downturn. Whenever the justification is, whatever the justification, it would be hard to prove that a new estimate is completely right or wrong until time has passed, because proof of the reliability of estimates is rarely available at the time an estimates is recorded. Managers have a readily available means for manipulating earnings at their discretion. ConAgra Foods Incorporated provides an example of how allowance and uncollectible accounts may be manipulated in order to manage earnings. A subsidiary of ConAgra Foods, United Agri Products, or UAP, engaged in several improper accounting practices, on one of them being understatement of a collectible accounts expense for several years. Exhibit 13 presents excerpts of the SEC's accounting auditing enforcement release. Okay. Two straight lines measure method shows consistent operating profit margins, and the other two methods shows varying degrees of increasing operating profit margins as the depreciation expense decreases over time. The example above shows the different amounts several alternative methods, but even more depreciation expense variation is possible by changing estimated lives and assumptions about, say, salvage value. For instance, change the expected life assumptions from 5 years from 10, and add expectation of the equipment will have 10% salvage value of its life and of life expectation. Example 17 shows the revised depreciation calculation. Notice that under the double declining balance method, the depreciation rate is applied to gross conduct. Unlike the other two methods, the straight line method and a unit of production method subtract the salvage value from the cost before the depreciation expense is calculated. Also note that the assumption about the usage of the equipment is revised so that depreciated only on its salvage value of $10,000 or $100,000. By the end of the estimated life, the total depreciation under the method is thus $900,000. Exhibit 18 shows the difference in expense allocation patterns of the method over the 5-year expected life, and assuming a 10% salvage value, although each method is distinctively different in the timing of the cost allocation over time, the variations is less pronounced than over the longer life and life views in the previous example. Perhaps one of the clearest examples of how choices affect both balance sheets and income sheets can be found in the area of capitalization practices and classification of payments made. Management must determine whether the payment will benefit only the current period, making it an expense, or whether it will benefit future periods, leading to classification as an account to be capitalized as an asset. This management judgment embodies the implicit forecasts of how the item acquired be the payment will be used or not used in the future. The judgment can be biased by the powerful effect of capitalization policies and have on current earnings. Every amount capitalized on a balance sheet are as buildings, an item of inventory, deferred costs, or an other asset is an amount that does not get recognized as an expense in the current period. A real-life example can be found in the case of WorldCom Incorporated, a telecom concern that grew rapidly in the late 1990s. Okay, this is just the example. Choices that affect financial reporting. Warning signs. The choices management make to achieve desired results can leave a trail. Like tracks in sand or snow, the evidence of or warning signs of information manipulation and financial reports are directly linked to the basic means of manipulation. Bias revenue recognition and bias expense recognition. The bias may relate to timing and or Location of recognition. For example, a company may choose to defer expense by capitalizing them, which relates to when an expense is recognized. In other examples, a company may choose to recognize a loss in other comprehensive income or directly through equity related rather than through the profit or loss statement, which relates to where the loss is recognized. The alert investor or analyst should do the following to find the warning signs. Pay attention to the revenue. The single largest number on the income statement is revenue. The revenue recognition is a recurring source of accounting manipulation and even outright fraud. Answering the question, is revenue higher or lower than the previous comparable period, is not sufficient. Many analytical procedures can be roughly performed to provide warning signals of accounting malfeasance. That's a funny word, malfeasance. Examine the accounting policies. Note of a company's revenue recognition policies. Look at the revenue relationship. And pay attention to signals of the investors. Although inventory is not a component of every company's asset base, its presence creates an opportunity for accounting manipulation. Look at inventory relationship. Compare growth in inventories of competitors of the industry's benchmark. Calculate the inventory turnover ratio, and the companies reported under US GAAP may use LIFO inventory cash flow assumptions. Pay attention to capitalization policies and deferred costs. In a study of enforcement actions over the 5-year period, the SEC found that the improper revenue recognition was the most prevalent accounting issue. Suppression of expenses was the next most prevalent problem noted. As the earlier discussions of WorldCom showed, improper capitalization can result in a significant misstatement of financial results. Examine a company's accounting policy. Note for its capitalization policy for long-term assets include interest costs and handling of other deferred costs. Pay attention to the relationship of cash flows and the net income. Net income propels stock price, but cash flow pays bills. Management can manipulate either one, but sooner or later the net income will be realized in cash flow, in cash if the company remains viable. When a net income is higher than the cash provided by operations, one possibility is that aggressive accounting policies have shifted current expenses to later periods, increasing earnings in the presence of declining cash generated by operating might signal accounting irregularities. Construct a time series of cash generated by operations divided by net income. Open potential warning signs. Another area that may suggest further analysis may be as follows: depreciation methods and useful life, fourth quarter surprises and presence of related party transactions, non-operating income or one-time sales included in revenue, classification of expenses as non-reoccurring, gross operating margins of out of line with the competitors or industry. Warning signals are just that, signals. Not indisputable declarations of accounting manipulations guilt. Investors and analysts need to evaluate the cohesive, not on the isolated basis. When an investor finds a number of signals, the subject investor should be viewed with caution or even discarded in favor of alternatives. Furthermore, as discussed earlier, context is important in judging the value of warning signals. A few examples of facts and circumstances to be aware are as follows. Younger companies with an unblemished record of meeting growth projections. Management has adoption of minimalist approach to disclosure. Management fixation on earnings reports. A company's culture is intangible to the investors should bear in mind when they are evaluating financial statements for the possibility of accounting manipulation. Management's highly competitive mentality may serve investors well when a company conducts business, or but the thinking should not extend to communication with owners of the company, the shareholders. The mentality can lead to the kind of accounting gamesmanship seen as earlier part of the century. Examining financial statements for warning signals of manipulation, the investor should consider whether the mindset exists in the preparation of the financial statements. One notable example is the mindset comes from the most recognized corporate names of the world. General Electric. In the mid-1980s, General Electric acquired Clickler Peabody and was ultimately determined that worth much than the earnings of Clickler had reported was bogus. As a consequence, GE was announced within days that it would take the non-cash write-off of $350 million. Hence, how former CEO Chair Jack Welch described the ensuing meeting of senior management and his memoir straight from the gut. It appears that the corporate governance apparatus fostered a GE culture that extended the concept of teamwork to the point of sharing profits to win one from the team as a whole, which is incompatible with the concept of neutral financial reporting. Although research is not conclusive on this question, it may be also worth considering the redisposition of earning manipulations and more likely to be present when the CEO and board chairs are one and the same, and when the audit committee of the board essentially serves to pleasure the CEO and lacks financial reporting sophistication. Finally, one can discuss whether the financial reporting environment today would be rewarded by or penalized by the CEO who openly endorses a view that he could legitimately exercise financial reporting discretion, albeit within limits, for the purpose of artificially smoothing earnings. Restructuring and or impairment charges. At times, the company's stock price has been observed to rise after the recognition of big bath charges to earnings of the current period. The convert management and a merger and acquisition orientation. Tyco International Limited acquired more than 700 companies from 1996 to 2002. After assuming the best of intentions regarding financial reporting and growth at any cost, corporate culture poses a severe challenge to the operation of financial reporting controls. In Tyco's case, the SEC found that it consistently and fraudulently understated assets acquired and overall liabilities assumed. Conclusion. Financial reporting quality varies across companies. The ability to assess the quality of a company's financial reporting is an important skill for analysts. Indications of low-quality financial reporting can prompt an analyst to maintain heightened skepticism when reading a company's report, to review disclosures critically when undertaking financial statement analysis, and to incorporate appropriate judgments in assessments of past performance and forecasts of future performance. Financial reporting quality can be thought of as spanning the continuum from the highest to the lowest. Reporting quality. The focus of this reading pertains to the information disclosed. High-quality reporting presents the economic reality of a company's activities during a reporting period of the company's financial condition. At the end of the period, results quality pertains to the earnings of the cash generated by the company's actual economic activities and the resulting financial conditions relative to the expectations of current and future financial performance. An aspect of financial reporting quality is the degree at which accounting choices are conservative or aggressive. Aggressive typically refers to choices that aims to enhance the company's reported performance and financial positions by inflating the amount of revenues, earnings, and operating cash flows reported in the period, or by decreasing the amount of expenses reported in the period and or the amount of debt reported on the balance sheet. Conservatism is in financial reports can result from either one, accounting standards and specifically requires on conservative treatment of a transaction or an event, or judgment necessarily made by managers when applying accounting standards that result in more or less conservative results. An example of conservatism is in oil and gas industries, the revenue recognition accounting standards. The standard permits recognition of revenue only at time of shipment rather than closer to the time of actual value creation, which is the time of discovery. Managers may be motivated to issue less than high quality financial reports in order to mask poor performance, to boost the stock price, to increase personal compensation, and to avoid violations of debt covenants. Conditions that are conducive of the issuance of low-quality financial reports include cultural environments, attributes that result in fewer or less transparent financial disclosure, book/text conformity, and shift emphasis towards legal compliance and away from fair representation or fair presentation. The limited capital market regulations mechanisms that discipline financial reporting quality includes the free market and incentives for companies to minimize costs of companies, auditors, and contracts, provides provisions specifically tailored to penalize misreporting and enforcement by regulatory entities. Pro forma earnings, also commonly referred to as non-GAAP or non-IFRS earnings. Adjusted earnings are reported on the income statement. Pro forma earnings are excluded. Negative items are all hallmarks of aggressive presentation choices. Companies are required to make additional disclosures when presenting any non-GAAP or non-IFRS metrics. Managers considerable flexibility in choosing the company's accounting policies and in formulating estimates provide opportunities for aggressive accounting. Examples of accounting choices that affects earnings and a balance sheet includes inventory cost flows, assumptions, estimates of uncollectible accounts receivables, estimated realizability of deferred tax assets, depreciation method, estimated salvage value of depreciated assets, and estimated useful life of depreciable assets. Cash form operation and a metric of interest to investors that can be enhanced by operating choices such as stretching account payables and potentially by classification choices. Okay, so this is reading 21. I read it in one sitting, although I did get juice on my fridge along the way. So, I do hope my readings have been helpful, and I do hope, obviously this isn't an infringement on copyright because I am not using the content directly, I am changing the content, so it is permitted under fair use policies of my country's copyright laws. Okay, we will continue next time's reading 32, about financial statements and analysis application in your next reading. So I do hope my readings have been helpful, and I hope to see you guys next time. Goodbye.